I mean, put yourself in the position of a central bank. You say, well, I don't like this. Where's my gold?
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. Now, this is the show that goes beyond the headlines to uncover the truth about the gold and silver markets with world-renowned whistleblower and industry expert, Mr. Andrew Maguire. And this week, he'll be joined by a very special guest that you all know, Mr. Alasdair Macleod. And we'll be, again, talking gold. This is going to be an amazing conversation. Fasten your seatbelts and let's head over to the UK and join Andrew Maguire and our featured guest, Alasdair Macleod. Over to you, Andrew.
Thanks, Shane. And thanks, Alasdair, for jumping in. Here we are. We're lucky to have you at the beginning of every single quarter, right at the beginning of January. Then we had you at the beginning of the second quarter. And here we are, just entering this exciting third quarter. So much stuff going on. I mean, some curveballs, but pretty much on track with what you were figuring as we entered those first quarters. So here we are, Alasdair. Thank you for joining us, and perhaps we'll start with wherever you want to start. But essentially, I was looking at a weeping Chancellor of the Exchequer the other day, and it was pretty scary, to be honest. And then you'd made some really salient comments about potential sovereign defaults. I mean, goodness me. Alasdair, where should we start?
I think actually the weeping Chancellor is probably a good place to start. I think we've all been there when things just get on top of us and it's just too much, and you sort of emotionally break down, if you like. And I think that's roughly where she was. I mean, the idea that this was personal. I mean, she may have had a riot with her partner or something in the morning, but that's not the point. I think it's quite clear that the reports coming in from Revenue and Customs are that the income coming in is going to be considerably less than forecast at the time of the budget. And this puts huge pressure on national finances. Furthermore, I think that the Treasury has seen an enormous number of negative points coming in. I mean, after all, everything she did in her budget was actually economically destructive. I mean, in a sense, you can understand her doing it because, she's backed by the trade unions. She's got people to pay off. She's also got a parliamentary party who is far left-wing, and elements of it that are rarely left-wing. So she had to do the socialist thing, if you like. And I guess, anyway, she sort of thought that, the landed gentry, those nasty people chasing foxes and all the rest of it, why should they get a tax break on inheritance tax? You can see the socialist arguments, if you like. Now, it is quite possible that there were elements in the Treasury who said at the time that pursuing the tax rises that she did, plus also the pay rises that she gave to civil servants, to nurses and doctors, and also railway workers too, was leading to really quite a problem. And she must expect that there would be, if you like, the arithmetic would start going horribly wrong. And sure, if it has. And I guess that there are those in the Treasury who are sort of biting their lips and trying not to say, well, we told you so. So I think that was behind her problem. Her problem is that, she sees the disaster unfolding. So she has to cut public spending because quite obviously we're over the Laffer curve when it comes to getting taxes. If you raise income taxes, more people will leave. The non-DOMs are already gone. And I mean, we've got a very unbalanced income tax structure. The top 1% pay 30% of all income taxes. So Where have they gone? They're all in Dubai or Milan or wherever, So the tax hit, the hit, if you like, in terms of loss in revenue is very, very great. And to be fair to her, there has also been Trump's tariff tantrums, which are poor for the economy, bad for the economy. Of that, there is absolutely no doubt. So tax takes are going to go down. And the last thing you do under those circumstances is raise further taxes. So there was only one thing she could do, particularly since her boss turned around and said, we're going to spend 5% of our GDP on defense. Now, that was a bolt from the blue. So she had problems. So what could she do? I mean, I think it was the Treasury came up and said, well, there's only one thing really which you need to do, and that is cut benefits. And you got to cut, and they detailed the benefits to be cut. But there was an outright rebellion in the House about this because socialists are elected basically to protect and enhance welfare. That's their mission in life.
Mm. Yeah.
So, the government had to back off. Now, this means that we are heading for a sterling crisis because, quite clearly, tax increases are, the increase in tax revenue is not going to happen. The increase in welfare costs and also unemployment costs from an economy which is sliding into recession, I mean, it's just going to knock the whole thing sky high. And it puts the UK in a debt trap. And a debt trap, by definition, is a situation where the tax income to back the mountain of debt is growing at a slower pace or even retreating in the face of rising debt. Who's going to lend you money under those circumstances? There is also a huge amount of debt in foreign institutions' hands. I mean, apart from banks, you've also got now quite a few hedge funds along of sterling. And sterling and sterling bonds, if you like, gilts and so on and so forth. They are net sellers rather than net buyers from now. So I would expect to see the 10-year gilt yield soaring through 5% in the not too distant future. And what does that do to sterling? Well, it unsettles sterling. So that's the situation here, Andy. And I think if you look at all the G7, they have the same problem to different degrees. We know the situation in Japan. I mean, the debt to GDP is just, 260% or something. In America, it's 120% or 120%. Canada is another one. If you look at Europe, France is, that's a mess. They can't cut anything. I mean, they had riots when they tried to sort of raise the retirement age just by a little bit.
Yes.
And Spain has gone far left. I mean, even Germany is taking the brakes off the debt limit. So all these countries are in deep, dire doo-doo. I mean, it's really as simple as that. This is actually a very, very unpleasant situation for all Western nations.
And I think the beauty of this was in the sense that this provides a window into the bigger picture. And for all those people think, oh, well, this is UK centric. Oh, sorry. But I mean, this is why I think I wanted you to sort of talk about it and how this debt trap leads into the bigger picture, credit bubbles, all of these things that you are all over, and you have been for this whole year and previous years, but this whole year, and how that is now unfolding. So yeah, and you also mentioned Trump's tariffs and the implications of how that the supply chains are all threatened now. I mean, this is a bad situation, is it not?
Yes, it is. And with respect to the tariff situation, I saw a chart, I think it was in the Telegraph this morning, which showed that the level of tariffs are now higher than they were at the time of Smoot-Hawley. We've just completely reversed all the progress towards free trade. But of course, I mean, we don't actually know the figures because, Trump keeps on changing the narrative. And I mean, he's obviously not getting the agreements in on time. So he's sort of extending it, and throwing out things like, we're going to tax copper 50%, import, come on. This is economically destructive. It really is. And at the same time, he produces his big, beautiful, wonderful bill, another 3+ trillion of spending. I mean, the man's a spendthrift. And at the same time, he's telling the world that the dollar should be lower, and interest rates should be lower, and Jay Powell should be sacked because he's asleep at the wheel. This is thoroughly irresponsible, particularly when you bear in mind that foreigners own this is according to Treasury TIC figures, just a short $40 trillion and underlying deposits and investments. So what do? I mean, already you've seen the dollar go down, and I mean, the chart looks terrible. So, we don't need to talk about fundamentals. But from a foreigner's point of view, he might be doing quite well on his Nvidia, which are now worth 4 trillion or something, capitalization. But apart from the odd spot like that, his 15 trillion in equities, his holdings of US government debt and agency debt and corporate debt and deposits, he's losing on the whole lot. What does he do? I mean, a foreigner's risk-free position is to get into his own currency because that's what he accounts in. That's what his profits are rendered in. If you're in a foreign currency, you have got risk. And I think this is the point which just doesn't seem to be fully understood. Now, having said that, I think the Fed and the US Treasury are waking up to the facts. They understand this. What the Fed is now trying to do is to remove the supplementary leverage ratio on the big banks, which were imposed on those big banks in addition to Basel III to try and reduce the amount of risk from banking failures in the economy. They've now turned around and said, well, of course, if we can reduce that supplementary leverage ratio, then it frees up banks to create credit to invest in treasuries. That's going to happen. But they're not going to buy anything out along the yield curve. The only things they will buy are T-bills. 3 months, 6 months, a year at most, but most of it I would have thought 3 and 6 months. So what does that mean as far as the Treasury market is concerned? Well, it means that the average maturity, if you like, across the whole of the Treasury market is shortening, which means more and more of it has to be rolled over every year. So, we don't know how long it's going to take for this funding crisis really to hit. But if the funding crisis hits in the dollar, you can forget every other currency because the dollar is the king rat of currencies. At the moment the dollar is going down, I think there's going to be a switch in that because dollar goes down, you'll probably find that something is said which stabilizes it a little bit, and then you'll see sterling going down the pan, and you'll see some traders coming out of euros as well. So, there will be swings and roundabouts in this, Andy. But I think that we're in a crisis, and of course, the other thing that so few people understand is the role of gold in this. I mean, it's not gold is real money. It is actually in Roman law a corporeal asset, whereas credit, which is everything else, including currencies, is incorporeal, and you cannot cross that divide. It's actually fixed. This is the way it is in our laws and also in our logic too. Gold has no counterparty risk. It is physical. Credit is a promise to pay at some stage in the future. It's something that doesn't exist, except, if you like, on a balance sheet. So it is incorporeal. The two things are completely different. So from the point of view of a foreign central bank with reserves, of course what they do is they're selling dollars. They're reducing the incorporeal element on their reserves. It's not so much they're buying gold, they're just getting the hell out of credit. That's what it is. And I think You mentioned, sort of quarters, sort of opposite from the timing point of view that I'm back on. I think really what we're likely to see is an acceleration of the deteriorating position of credit over the rest of this year compared to where it was earlier than this year. It doesn't look good to me, I'm afraid, as far as credit is concerned. And the other thing which has everybody got wrong, and that is interest rates should not fall. Now, I can't say that the Fed and other central banks won't reduce interest rates, but they would be stupid to do so because all they do is they undermine the value of their currency. It's not going to help the funding at all. If anything, when you've got greater risk in credit, then bond yields, the coupons, the interest rate on that credit has got to rise to reflect that risk. It must do. Otherwise, nobody buys it. So, yeah, not good.
And the thing is that, as we've spoken about before, a lot of the people that are blinkered and chasing risk assets with ignoring all of these factors because they were never around when there was a previous crisis. Now, I still remember, and I know you do, Alasdair, when in the 80s, I mean, when we had the last sterling crisis, for example, and I remember interest rates in the teens. And I remember in Gloucester, near where I was or am, an entire divisions, housing divisions where there were professional people, school teachers, et cetera, who couldn't pay their mortgage anymore. And the banks were loath to repossess because it would have meant marking it to market. And the whole derivative chain would have imploded. And speaking of derivatives, and I know we've spoken about this before, I mean, these interconnected derivatives, and that's form into gold as well, and they touch everything. I mean, could be 2 quadrillion. It could be, I mean, who knows what these numbers are? You lose track. When you start to talk about quadrillions, it's hard to even conceive the size of that. But we've been through these situations before. And when you see people barreling on and to ignore something as serious as what you just talked about, and the result of that will affect everybody.
I think that's right. I mean, there's an unwarranted, if you like, confidence in the ability of government to manage a crisis. Keep everything on an even keel. I mean, look what happened in 2008-9. Okay, there was a little bit of disruption, but we sailed through it. We're here, and we've got a wonderful bull market, and isn't it great? And we're all getting wealthier. Yeah, I mean, what that ignores is another theme that I've been banging on about, which I think is desperately important, and that is the cycle of credit. I think it's quite difficult if you're in markets to really realize that you're in a credit bubble. The way to look at it is that because for every credit, there is a debt. You've got an obligation for every credit, okay? We are in a debt bubble. Now, that is unarguable. I mean, not just government, but also households, everything else. We are in a debt and therefore credit bubble. This was exactly the situation in the late 1920s. And that was followed by the Wall Street crash. Wall Street peaked out in September 1929 and lost roughly 90% of its value by the middle of 1932. And the other thing, which rhymes with today, is Smoot-Hawley Tariff Act, 1930. That actually was passed it was passed through Congress before the market peaked. I don't think it was taken all that seriously. It was then endorsed by the Senate in early 1930. And a month or two later was signed into law by President Hoover. And I mean, the moment he signed it into law, everybody thought, oh my God, what's going to happen? And of course, you found that country after country said, well, if you're going to tariff us, we'll tariff you. Tit for tat. And it meant that industry, in terms of its manufacturing, was having to pay more. I was like, what's my imported coppers going to cost? Which, is Trump's latest wheeze. 50% tariff. I mean, it's ruinous for American industry.
Yeah.
And we have got exactly the same thing today. And this is why it's so important. That little chart I saw, which told us that it looks like tariffs are going to be a little bit higher than they were after the Smoot-Hawley Tariff Act. I mean, we've got exactly the same situation. So and not only that, but if you look at the valuation basis between bonds and equities in America, any way you want, but particularly America, because that's quite easy to chart, the S&P is more highly valued relative to the long bond than it has ever been in history. It is more than twice as overvalued as it was in April 2000. The dot-com boom, more than twice as overvalued. If we see the long bond yield beginning to rise from here, you're going to get an equity market collapse developing, just like Wall Street in 1929. It's going to be another October 29. Now, I don't know when it's actually going to happen because everybody is asleep at the moment. As I think we agreed before we went on camera, so many people are either watching Wimbledon or watching cricket or out on the beach or whatever in this wonderful weather. Nobody's paying any attention whatsoever. And I recognize this on my Substack, along with fellow writers of Substack. They say, well, this time of year is always quiet. You can sort of market and do this, do that, and all the rest of it, but forget it. Nobody's interested. And that's where we are. So this is why you sell in May and go away. It's not necessarily because the market's going to collapse. You sell in May and go away because nothing's going to happen until you come back in August, late August, early September. And I think we've got the same syndrome now. But this situation is so stretched that I don't think that it can go much beyond the, if you like, the later stages of this summer. It is so stretched. And interestingly, Andy, from the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver has got, a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to mark-to-market on their shorts or whatever it might be. It could happen yet, but there's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken. So over to you on the market.
Again, silver provides a window. It's obviously gold is much more complex to follow. The footprints are much easier to read. But the thing is, I think that, and we were talking about 35 resistance. Now that's become support. And in fact, even 36 looks like support. So why is that? And I think what it is that personally, I believe this, and we track our liquidity providers in Asia and what it's happened. I think that silver has a sufficient open interest or let's just say the sufficient COMEX open interest and LBMA open interest that has now escaped into the physical markets. I think it's jumped the ring fence. I think they're having very, very much trouble in keeping silver down. And I think it's almost, and to me now that kind of raises, you mentioned 2020. If we look at gold in 2020, we had 800,000 contracts of open interest. And I know you follow this closely. Now we're around half of that, maybe a bit over half of that. And some of that is momentum short positions. So, and yet, as you know, the gold price continues higher without that open interest. So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets, where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold. We're seeing that open interest really dwindling. We see it evaporating. Where's it going? It's not evaporate. It's a finite equation. Where is it going? It's going into the physical markets. So then you've got the unwind of leverage, hence the price increase. So I think that silver is providing the key to what we're seeing in gold, which is it is going to also exit itself from the controls of the LBMA CME, who have been sitting on that between them for 50 odd years. And I think when the physical markets are being determined somewhere else, and you can try and delay Basel III all you want in the US, all that's going to happen is you don't adhere to that. You continue to play paper games. Well, when the liquidity has flowed out into the physical markets, and they turn around and just simply say, give it to us then. And then essentially, unless the COMEX ultimately becomes equally Basel III compliant, every ounce is going to vanish.
That's interesting. The other thing I did notice is that in 2023, China exported an awful lot of silver, and to my mind, was suppressing the market. And the thing that was interesting is that amongst the largest takers of this silver were places like Hong Kong, Singapore, and London, which I would regard as predominantly financial centers rather than photovoltaic manufacturers. Last year, 2024, these financial centers dropped off. There was still a sort of net export from China. I mean, there's no doubt that China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, silver, platinum, and so on, I mean, suddenly there's a behavior going on there, which we're not all that familiar with. Your comments, please.
I honestly believe that's because the price of the physical metal is being determined in a physical exchange, and it's literally. And then you've got the paper open interest, literally exiting to where a real market. Now, for example, if I'm a producer and I've been financed by the LBMA, and this brings to mind Citi's call for $2,600 gold. And we know, and I'm absolutely certain of this, that they were forcing producers to sell forward based on the fact that they said, well, we think the treasuries, the stock markets are going to do well, that the US is going to boom. Interest rates are coming down. This is their comment. This is their comment. And so therefore, with all of that in mind, gold's going to lose $600 by 2026. And even as much as yesterday, the head of UBS was out there talking about that. It's rubbish. It's absolute rubbish. So they force, and I think the real point I'm trying to make here is they finance a number of producers. Now, if you finance that producer, and you tell him to hedge a position and you sell it forward,
it's the bank.
You're going to take the long side. You've robbed them unnecessarily, because there's no way that with the physical markets exploding elsewhere, being set elsewhere, and them losing control. I really strongly believe that them forcing the producer that you finance, because if you withdraw his banking, his business goes down. So it is a debanking situation. So as far as gold's concerned, I think that is also, I think that game, if I'm a producer, why would I want to be financed by a predatory, after being treated like that? I would much rather take my financing from China, I'll take an ownership position, let them take an ownership position. We'll do much what the BRICS is trying to do, become take the barriers down and sit at the same side of the table, and we'll all make some money. So to me, I think that's happening.
That's a very, very good point. And also, of course, the rise in the gold price means that cash flow pressures on mines are not as great as they were. So, I think that, the Citicorps and the UBSs from manufacturers are being given two fingers, basically, I think.
Yeah.
I think what you say is very interesting. There is another aspect to this which I want to explore a little bit with you. We had an announcement, I think it was a sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter, or compared with, previous quarter, or the previous year, whatever. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together. But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated. Now, nobody really notices this, but they are absolutely huge. Now, I know that the exchange for physical are even greater, but, we don't know whether that's one way or the other way. I mean, it can be both ways. But, we've got hard evidence with stands for delivery. Interestingly, the Bank of England's vaults lost 14,048,000 ounces between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million for a total of 20,751,000 ounces.
Wow. Yeah, that's big.
The stands for delivery in that time, interestingly, were a bit over 22 million. 22,036,500. Now, you can't necessarily say that these figures are meant to match, but you can see that you've got a problem on one side and you've got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years. I mean, I think I'm right in saying that between 2021 and 24, stands for delivery were around about 2,100 tons. This year so far, we're running at the rate of an annualized 1,500 tons. So we're running at close to 4 times the rate, if you like. More, I suppose. Now, the interesting thing, and this is something which I think the ECB is actually worried about, is that all this stuff disappearing from London, how's it going to get back? Because the point about an arbitrage is you do one leg and then you do another leg. Now, what you might do is you might protect your position by, say, taking out an out-of-the-money call option just in case the price rises too much. But if you've actually, say, taken 20% premium, which at one stage you could do by literally begging, borrowing, or stealing bullion from one centre and selling it into another centre, you've got to get it back because you've got the obligations from where you got it. And this is the interesting thing, because the Bank of England, as I say, you had leaching out from. You had 14,048,000 ounces. Now, this is interesting because I don't believe that bullion banks and hedge funds, whatever, store much bullion in the Bank of England. It's predominantly central banks. Would you agree with that, or am I wrong?
No, okay. You're right.
So what that means is that the system whereby the Bank of England turns around to a leasing central bank and says, "Don't worry, you'll earn 1%, whatever the figure is, and it'll pay for your storage costs, which is lovely. It's lovely for us, lovely for you." And we have a book entry transfer system. So, the bullion stays here, and at the end of the lease, you'll be able to get it back. It's gone. It's gone. So what happens? I mean, put yourself in the position of a central bank. You say, well, I don't like this. Where's my gold?
And the ECB, and to what you're talking about, they're absolutely right. The ECB Financial Stability Review, they put out a link to the report, a full report, a long report. But in summary, what they're saying, they were drawing attention to billions of unbacked, as they put it, unbacked, unallocated paper gold positions. And then they identified these, what you're talking about, foreign counterparty derivative exposure, that they said, well, there clearly has to be bought back into rising prices. So it is exactly what you're saying. So yes, when it comes to the end, that's what you're saying. You're going to have to buy it back at a higher price to repay it.
But it's worse than that. It's worse than that. The liquidity in the paper market is backed up by leasing and a rehypothecation of leases and all the rest of it. I would be very surprised if the central banking community are prepared to extend their leases anymore. I think they're saying, no, we're not doing this anymore. And some of them might indeed be saying, we want to store our own gold. Let's have it back. So this is fatal, really, for the paper market. And I suspect that the second half of this year, we're going to see this. Now, the problem you mentioned sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk escalating everywhere. And this is going to be actually, well, let's put it this way, as the Chinese would say, interesting.
Well, yes, because you're talking about a physical gold as a first tier, high quality liquid asset. Absolutely. So ultimately, the rubber meets the road at some point. The derivative rubber meets that road at some point, because when you're having, there was a time when, as we know, you could just keep rolling and rolling and rolling this position over. And in fact, for forwards of less than 14 days, you don't even have to report to the office of the comptroller, and it just went on and on and on. But when somebody else is actually saying, hang on, I'll buy it at that price, and I have a client to buy it at that price, and I'm a central bank and I want to buy it at that price, then you're going to have this series of higher stair steps along the way, which are physically supported. They're not the paper market price anymore. And I think that is the process that, and you're talking about as the year rolls out. I think we'll see that this year. I think you're right that it's going to happen.
The other thing that's interesting in this is we see the gold price rising, up close to all-time highs and so on and so forth. The amount of interest in the West is actually pretty low. And you look at COMEX and you see, as you said earlier on, you've got 440,000 contracts open. I mean, this to me is sort of marginally oversold. I mean, how do you get something marginally oversold at the top of the market?
Yes.
There is another thing. It was reported on Kitco, and I had some Australian friends who were asking me about this. The report that the average portfolio from the sort of people who've got a bit of money, and I think the definition when you delved into it were people who had over $100,000 up to $2 million, that sort of thing. I mean, sort of, if you like, the affluent middle classes. And they reckon that something, I think, between 11 and 12% of their portfolio was in gold or gold substitutes of one sort or another. Now, this is not our experience. So I dug into this a bit more. And in fact, it was an HSBC report which covered 12 different jurisdictions, only 4 of which were outside Asia. And the 4 basically were Australia, Canada, the US, and the UK. Now, we know that our exposure, US exposure, portfolio exposure is, square root of nothing virtually. But what it does indicate is the level of interest in Asia in gold. And it's far higher than we think. This bull market, if you like, in Asian terms, has got a long way to go yet. Because, of course, if you look at China, the alternatives are not that attractive. I mean, the banks have reduced their interest rates, so deposit rates there are a waste of time. Property is a busted flush. Stock market is not everybody's flavor. Yet household savings amount to 35% of GDP. I mean, an extraordinary level of savings. This is going into gold. And we're talking about an annual flow of over $2 trillion. So, this is an interesting juncture. And remember also that Chinese, housewife, Mrs. Wong or whoever she is, can't rush out and buy dollars or Swiss francs or whatever verboten. So she's got, the only thing she can do is tell her bank, open a gold accumulation plan for me and feed, X thousand yuan into it every month. And that's what's going on, I think. And also India too. That's interesting. And of course, both nations, and this takes us back to silver, both nations do see silver as money, even though we've forgotten that. And central banks don't get involved with it generally. I mean, PBOC is involved with it because they have the monopoly, if you like, of acquiring and disposing of the nation's silver. But other than that, no central bank is involved with it, or they certainly don't make returns showing that they hold silver as part of their reserves. But I can just see these shortages mounting. And as far as the West is concerned, the underexposure in portfolios is really quite shocking. I mean, you would normally expect in a balanced portfolio to see some mining stocks all similar, representing gold, silver, maybe platinum, or things like that, and maybe copper as well. But nobody's been interested for so long. And with respect to gold, I calculated that all over the world, if you look at, I think we've got something like $300 trillion worth of portfolios. How much gold is in them? It's less than 0.5%. Partly because gold itself is not a regulated asset, and therefore your compliance officer jumps down in your neck if you try and buy any. But they're not yet really piling into ETFs, which of course the compliance officer has got no problem with. So I think there's an awful long way to go from that point of view before we even start talking about, well, what's driving gold? The answer is that the purchasing power of our currency is going down. They are not there yet. They don't understand it. They really don't. I tell you, I've got an uphill struggle getting people to understand that it's credit going down, not gold going up.
Yeah. Well, and that's been your message all along. And I think it's, as you say, and I think you also use this, a sovereign as a perfect example. And you say, well, you can exchange that in the 30s for £1, and now what's it, £500? I mean,
600.
Or 600, exactly. But the thing is, I always carry one around in my pocket because it destroys anybody's argument. And they go, well, gold, isn't it volatile? Well, no, it's not volatile. In fact, you see, I've I'm calling it 500. I should have, if someone had offered me 500, I wouldn't have sold it anyway. I wouldn't have sold it for 1,000, to be honest. Physical gold, I never sell.
You'll be putting it back in the vault. I tell you, I did that once. I was speaking at a function in London. So I travelled up by train to London with a sovereign in my pocket, so I didn't realise speech. I sort of waved it around, and I lost the bloody thing.
Oh no!
I'm not doing that again, I can tell you.
Oh dear! If somebody was happy, mind you, they probably didn't recognise it. Probably swapped it for a Mars bar or something, you know. Oh no, Alasdair, this is fantastic, and it's timely because I think you've drawn attention to some really important things, and I think, you know, obviously gold, and obviously you and I always talk about gold or silver. It's physical. We don't talk about paper, silver or gold. And I think this is a huge opportunity. I think this is a huge opportunity. Anyone who thinks, in my view, who thinks that they've missed the boat, that will wait for a pullback. And yet, when you look at your pound, your dollar, your euro in your wallet, I mean, where's the argument? That is debasing rapidly, and it's not. So if I had any spare dollars or euros or pounds, I would just rather quickly as possible put that into gold and silver, because it's simply going to require more of those silly notes to buy the same bit of gold in a month, 2 months, a year from now.
It goes back to the difference between money and credit. Real money is corporeal. I'm talking about the legal position. In other words, it is physical, it is gold and silver, and to a lesser extent, it was copper, though we forget that. I mean, you and I remember coppers. But and everything else, all the credit, including currencies, is incorporeal. In other words, it's nothing. It doesn't even exist other than an obligation in the future. I mean, this is why, if you look at the banknote, a Bank of England banknote, you get a script on it, which is getting smaller and smaller, I must say. It's getting into the real small print now. I will exchange this on demand for £1. You know, what? No, it's now £10. I mean, we don't have £1 notes anymore. Exchange this for £10, signed by the chief cashier at the Bank of England. And what he's referring to is £10 in gold, if you like, at the official rate, which is still one sovereign equals £1. And as we say, the loss in value of the pound means that a sovereign is now £600. It's the pound that has gone down. And I think all these guys who sort of fiddle around with government statistics about, you know, inflation and all the rest of it, just miss the point entirely. The thing to do is to, you know, if you want to know how prices have changed from, say, the 1930s to today, I mean, basically, they are 1/600th. The pound is 1/600th of its purchasing power then, or price has gone up 600 times, whichever way you want to do the equation or diffraction. So, yeah, and is this changing? No. If anything, the situation is accelerating, which was going back to what we talked about right at the beginning, which was why Rachel from accounts, finds herself in enormous difficulties, and she sort of broke down, which I sympathize, I understand, rather than laugh at, because actually it's all our fates. She's made mistakes. She's made huge mistakes in her first budget, but they're political mistakes, and I can understand the mistakes. They're stupid nonetheless in economic terms, but politically that was the way it was. And we as electors voted these guys in, or by default, admittedly, but, you know, you can't but sympathize, I think, with the predicament that she now finds herself in, because it's all our predicaments, in fact.
No, that's well said. And so this is about, what we're really discussing here is talking about wealth protection. And this is what it's, really, that's what we're talking about. What do I do? Yes, we've had this discussion. There's problems. They are coming, and they can roll out in different ways we don't know. it's the uncertainty. But what we do know, and there's one thing we can do, and we can take the responsibility for ourselves listening to this and simply protect our existing wealth as best as possible. That to me is the sum total of what we're trying to achieve here.
And it's no longer a time of trying to accumulate more wealth. It's a time of protecting what you've got as much as possible.
Yeah, well, I mean, that well said. And you know, talking about copper, people have woken up now and are minting copper coins. It's interesting, isn't it? This whole commodity cycle. I mean, really, again, it's just, even if I touch this table or this computer or this book or whatever, it's just going to cost more pounds, dollars, euros to buy the same thing next year. So it's really a no-brainer.
I agree.
Alasdair, thank you for sharing your valuable time with us. And now, Substack, you make every day, you're out there, you're making salient comments, notice in the morning, giving an idea of what's going on, what am I seeing, and an in-depth, salient view. So people can access that through your Substack channel. I know that there's a paid side to that, which I honestly believe, and I honestly truly believe this: something for free doesn't really have a lot of value. Because if you pay for something and then you are focused much, much more on that information, you take it seriously, you go in there, you weigh it. I mean, look, there's 5 million pieces of, I get how many emails do you get? 300 a day. I mean, you can't even look at them all. So the point is, you have to find a channel where you can find enough time. Where am I going to put my time? Well, okay, Substack, Alasdair, there are people very much like you out there, but it is a really good source of information. And quite honestly, you have so many years of experience. You've got this sort of overview, which a lot of people don't have, that, literally people are struggling to find out, to understand what's going on. And then you can draw parallels, you can bring the history in, and you can put some backup towards it. I honestly suggest that people do go and check you out. And is there? So obviously, we'll put the link in right away. But is there anything you'd like to say about your channel?
Well, yes. I mean, the mission basically is to educate the ordinary person. I have no other interest. I don't market anyone's, sort of facilities or whatever on the Substack. I'm absolutely desperately keen to ensure that everyone gets the message. I mean, gold money was great, but in a sense, you're already preaching to the converted. And not only that, but, in the majority, the converted are sort of quite wealthy. They're already storing, reasonable amounts of gold and silver. But I just want to get to the ordinary people, because the collapse of currencies, if it is permitted, and at the moment it's extremely hard to see how it's not going to happen, is going to be absolutely devastating for everybody. I mean, it really is. The ability of government to provide the welfare for those who are suffering, those who are handicapped, those who have no work, is going to be extremely limited. The welfare is going to be worthless, and pensions will be worthless as well. So they won't be increased to take account of the devaluation of the currency at all. I mean, what I see, and I hope it doesn't happen, I really do. What I see is something that is going to be so terrible for communities, for individuals and communities and all the rest of it. And I think if I can get people to understand these dangers and understand why they are dangers, then they will be prepared, and they'll be prepared not just for themselves, but also for their loved ones, their communities, if you like. And they will know what is happening, and they'll know, if they're so minded, as to what they should do to try and help others. So this is a lot deeper than just saying, go buy gold, or, No, I'm sorry. That's not what we're talking about at all. We're talking about education. And that's the important thing.
There it is. So people know that they can they click on the link below, join Alasdair. I know you're available for on email as well. And if somebody has a particular question, or if it's a fund or someone that wants some more detailed advice. But thank you for joining us. I do encourage people to land on your Substack site and check out what you're saying every day.
Yeah. Well, thank you very much for having me on, Andy.
My pleasure. Thank you so much.
All right. Thanks for joining us on this episode of Live from the Vault, brought to you by Kinesis Money. I really hope you enjoyed that conversation as much as I did. And a huge thanks again to Andrew Maguire and our featured guest, Alasdair Macleod. Now, we're going to put his Substack link below there. So if you want to get more information, you want to join the Substack, go ahead and click the link below. And thank you so much for cutting through the noise and sharing insights, again, that you won't find anywhere else. All right. So if you like this episode, make sure you subscribe, turn on notifications so you never miss out on an episode like this one. And don't forget to share this episode with someone who needs to hear the real story behind the headlines. So we're back soon with more hard-hitting truths from inside the precious metal space. And until then, thanks for watching. Bye for now.